Welcome to No More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen.
Hello, and thank you for tuning in to another episode of No More, Risk Better, a CreditSights podcast. I'm your host for this episode, Zach Griffiths, head of U.S. investment grade and macro strategy. And today I'm delighted to be chatting with Kerry Kantin, the U.S. bureau chief at LFI, and Hunter Martin, our head of media and cable at CreditSights. Thank you both for coming on the podcast.
Thanks for having me.
All right, so today we are going to be talking about the EA deal being taken private in, I believe, the largest LBO on record. But before we get into that, I want to start with a very brief speed round for Kerry and Hunter for the spirit of this EA deal. I want to know, starting with you, Kerry, what is your favorite video game of all time, or what do you think the best video game of all time is?
Okay, so I've got to admit before this starts that I'm knowledgeable about leveraged finance, not that knowledgeable about video games. My video games sort of go back to when I was a kid and there was the Power Pad and you played Duck Hunt. I really did like The Legends of Zelda though, but I'm dating myself with this. But I don't know how germane this is going to be, but
Classics.
There you go.
Hunter?
Yeah, I think I'm similar to Kerry. Maybe we're similar age, but it was kind of that old school Nintendo, probably just original Super Mario Brothers. And I would say that, like, for whatever reason, when we switched to kind of PlayStations and Nintendo 64, and you went from having two buttons to having like triggers and things, I was getting crushed at NHL and things like that, and or GoldenEye, and I was out, and I kind of never got back into it.
All right, well, maybe I'll buck the trend instead of going with more of the old school stuff, which certainly resonates with me as well. I was a big Halo guy back in my, I guess, middle school and into high school days. I don't think Halo is EA. I think that's Activision Blizzard, which I believe was another big deal recently. But with that out of the way, now that we understand each other's video game preferences, Hunter, can you start by framing up the transaction, who's involved, who's taken EA private, some of the high-level details just to kick things off for us?
Yep, happy to start there. On, I guess, Monday, the 29th of September, EA came out Monday morning with an announcement that it had reached a deal with an investor consortium to be taken private in an all-cash deal at a $55 billion valuation. So that was $210 a share. It was about a 25% premium versus the unaffected price, and implies a very hefty, like 18 times by my estimates, EV/EBITDA multiple. And as you said, this would be the there's been a lot of kind of debate about if it's the biggest LBO or not. There's different definitions, but it is the second biggest video game M&A deal, following Microsoft's purchase of Activision Blizzard that was $69 billion, and it's well ahead of Take-Two's acquisition of Zynga at a similar time. So in terms of this buyer consortium, so they did not disclose like what the percentage holdings will be, but the majority holder, the majority investor of the consortium is led by Saudi Arabia's Public Investment Fund, which maybe we'll get into later, has been active in kind of the video game industry in recent years. Then at kind of the lower end, you have Affinity Partners, which was founded by Jared Kushner. They are reported by the press to have around a 5% stake. kind of if there is a take private, and then you have Silver Lake, a financial investor with the remainder. And in terms of the deal was announced, about a week ago, and now we're at the stage where there's a 45-day go shop period where EA can kind of look for other offers. I personally do not anticipate them getting a higher deal, and then the next stages after that will be a shareholder vote, to approve the deal, and then a variety of regulatory approvals both in the U.S. and then other international markets.
Great, that's helpful, Hunter. And so at this $55 billion valuation, what does this mean for the leverage profile of the company once this deal goes through, assuming it gets through those regulatory and other hurdles?
Sure. So right now, EA has about 0 times leverage, or they have a net cash position. And this is an industry that just historically is not one where we've seen a lot of debt. So this deal at a kind of 18 billion of debt forecasted closing, by my estimates, that implies about a 6 times gross leverage. That's using our forecast of around 3 billion of EBITDA in 2027. I would note that I've seen some different multiples out there because the video game industry has some kind of accounting peculiarities, I guess I would say, with kind of live services and other aspects, but that's kind of the EBITDA we're going with. The company does generate around 2 billion of free cash flow, so I think the debt component or the interest component here will eat up a good portion of that, but they should still be, have a healthy amount of, I think, free cash flow to delever or to service that debt. And a couple other things on kind of the financing side. I think it is interesting, right? This is kind of the mirror image of a lot of LBO structures, where right here it looks like the debt component is going to be around a third of enterprise value, and then a really big equity check coming from this investor consortium. Usually it's the opposite, where they're only putting in 20 to 30% in terms of the equity check, and the rest, you have like 70-80% of the transaction is debt financed. So this is, while it is a lot of debt that will be raised and a lot for the industry, it is, I guess, less debt proportionally than you would usually see in an LBO transaction. I think that's partly a function of the involvement of this, Saudi's PIF. And while there hasn't really been a detail on how, what's the composition of that debt, I would say we kind of expect it to be largely secured. I think the rating will probably shake out to around like single B, maybe low double B. And finally, I wouldn't be surprised if like either Silver Lake or Affinity Partners, if they end up, part of their contribution ends up being like preferred equity instead of just like straight cash investment. So there could be kind of other debt-like instruments as part of this total deal comp.
All right, there's a lot of good stuff in there, Hunter. I want to unpack, but before we do that, what does this deal, in your opinion, mean for the existing debt? I know there's not a lot outstanding. They have a net cash position, but what does this mean? What's your expectations for the existing debt? Or there's some change of control considerations? Take us through that.
And great question. So EA had $1.9 billion of bonds. 400 million of that is going to mature in March 2026, so it's kind of irrelevant. And for the remainder of the debt, it's kind of the question: what happens to it? As you said, right? Does it end up at the bottom of with behind a bunch of other secured debt? So we think that these bondholders are going to be pretty well protected here. We think this transaction will kind of meet the requirements of a change of control put. So people, we don't see this debt's kind of staying outstanding in kind of the new structure. The put would be at 101. However, we think for the company, that won't happen because it's optimal, or they have the ability to instead redeem these bonds at the make-whole level, which is around par. So that's a price at par. So if they have the option, 101 or 100, they will do the make-whole level. And that these bonds, these were issued back in 2021 in a much lower interest rate environment, low coupon. The long dated bonds were trading in the 60s, mid 60s before this. So obviously they ran up significantly in this, under the hopes of getting par or 101. And we think they're kind of trading with a high likelihood that the only uncertainty is, does this deal kind of get approved? Does this actually happen? But the final thing we would note is that so it looks like if this deal happens, we think they'll probably be taken out at around 100 or tendered before the deal closes at 100. But we've had an immense amount of incoming calls and questions about this possibility of what's called defeasance. So the defeasance price of these bonds is well below par. It's a function of the fact there were interest or issued in a low interest rate environment. There is some precedent for this recently, where in the Walgreens LBO back in July, the bonds were tendered at a level below par and below 101, near this kind of defeasance price. So we're getting a lot of questions over if that will be the outcome. Our current view is it's unlikely that they will be defeased at a lower price. We think this is a function of just some of the language or some of the requirements to defease the bonds. We think the timing doesn't quite work in this instance. And it also, there appears to be one of the covenants about the requirements to remove certain covenants, particularly the change of control, that often requires a majority, but we think in this case it might require basically every bondholder to approve that. So our view is defeasance is unlikely, so we think you're kind of playing for par here, but that is still kind of open to debate.
Playing for par sounds a lot better than my golf game. I have one follow-up for you, Hunter, before we get Kerry's view on this. In terms of the makeup of the deal comprising a lot more equity, I know you briefly mentioned the involvement of PIF, and is that just maybe they have a lot of cash they want to put to work? What's your view of this, as you said, being kind of a mirror of what you'd expect, or what has historically been the composition of equity and debt in these large leverage buyout transactions, or large take private transactions, I suppose?
I mean, I think it does. Maybe Kerry might want to jump in, but like historically, we would see, depending on market conditions, like 20-30% kind of like equity contribution. The rest was debt, but that comes down to the type of business that you're borrowing against. It comes down to, what market conditions are, how willing people are to lend to you. So I do think this situation is kind of where Saudi's PIF I think they want to not over leverage this business as well. It's one thing. I think they view this as a very strategic asset. So they're kind of balancing, we need these financial partners to kind of get the deal done, but we also view this as kind of a long-term holding, and we don't want to risk the business. I think we have not heard their strategy, but they might also have plans to, say, invest aggressively in this business. They might want to grow the business more than EA can currently do with public shareholders. So I think that's another reason. But I'll let Kerry, I don't know if she has some other color as to kind of what composition we're seeing in recent transactions.
Yeah. So, when you look back to sort of the jumbo LBOs from, the pre-crisis era, yes, the equity checks were very thin. In fact, our colleague Steve Miller puts together this report annually that looks at kind of LBOs, and they take the top largest and they look at the ones from like 2007 and compare them. And if you looked, and I happen to pull some of these data up before, and in the 2007, the 12 largest, the average equity check was 23.5%. But in 2024, it was 58.5%. And I know the Dayforce deal, which Thoma Bravo took private, it just priced like now. I want to say, I'm pulling this off the top of my head, but I think it was roughly 56% equity. So this larger equity check, it varies. It definitely varies. But the deals now are not done like they were, in the pre-crisis era. Though I do agree very much with the comment about having more secured debt. I feel like the best model, a lot of the jumbo deals are very, very old, and things were very different, aside from the fact that the market fell apart before a lot of them were actually syndicated. But I feel like the Medline deal from 2021 might be like looking at the debt, equity mix, secured, unsecured, might be a decent guide to, what EA could look like. So that's just one, thing to chime in there. I will also say, having a lot of secured debt, I imagine that they'll tap sort of secured. They'll do loans, bonds, probably cross-border element. They could do secured and unsecured bonds. But sponsors like the prepayability of the TLB market, particularly if they are looking to delever here. So,
Thanks, Kerry. That's helpful. And so I recently was doing a TV interview, and I got asked the question how I thought the syndication of the $20 billion debt, or the check that JP Morgan has written, so that kind of the debt financing part of it. And admittedly, I had a moment where I was like, do they have a private credit arm that might just take down the whole deal? I feel like that's been such a big part of this. I know you kind of just mentioned You see likelihood of secureds, unsecureds, maybe across various currencies. Thinking about what you're seeing in the market today and understanding that this deal is not going to go to market anytime soon, as we need to get through various hurdles, and we can kind of discuss expectations for time frame. Maybe give us your view of what's hot in the market now and how current conditions may shape the market that this deal eventually comes into over however many months.
And so it's a little hard to know exactly because a lot of these things, particularly if you're looking at what's the mix between secured bonds and term loan B, clearly it will depend on the relative value at the time. And I'm not even exactly sure when the deal's coming and what things are exactly going to look like. I know they're going to want to probably have some flexibility to best optimize the capital structure. But with respect to private credit, I sort of don't think so. I know it's the hot topic these days, but if we're thinking this is like mid-single B corporate, which is sort of what I think Hunter was saying here, maybe with facility, the secured debt a little higher. I don't know that this would offer the yield that private credit folks would want. If you look at data we work with a firm called Lincoln International, and they provide us data around private credit transactions, and a unitranche for a, private credit borrower with 100 million more of EBITDA is like S plus 450 to 525. And so I would think that the yield that, the coupons that the company would want to pay on this debt might not really be in the ballpark of private credit unless they decided to do a second lien component. But I have a feeling it's going to be secured and unsecured bonds is my gut reaction there. As for the market now, over the summer, there was post Liberation Day and all the tariff induced volatility. And this affected, markets across the board. There was a slowdown in M&A, and the loan market technical became incredibly hot. And because of the lack of call protection, there was sort of a crazy amount of repricings. We've already started to see over the summer, the M&A calendar began to rebuild. And already we were sort of starting to see some better balance come into the market. And if I had to make a guess, not knowing exactly when this comes, guessing maybe early 2026, assuming there's no major disruptions between then and now, I would assume that the conditions maybe feel somewhat a little bit more like where they do today, where there's some new money, there's a good amount of new money, albeit not like 2021 when, low interest rates fueled an LBO.
That's helpful. Thanks, Kerry. And I just want to actually hit right on that question of timing and turn it back to Hunter. Do you have any particular expectations with respect to deal timing? And I'd say one of the big focuses this year across the market has been deregulation. Are you seeing any major regulatory hurdles for any of the investors or anything from the regulatory side of the house that you see as concerning or potential to delay the closing of the deal?
Yes. So the company they do have a closing date, or they've kind of a closing target, which I believe is during like the second calendar quarter of 2026. So it's kind of like it should be pretty early. And in terms of like what we're looking at or what are the things that need to happen before then. So we have the shareholder vote, but then you have these requirements for regulatory approvals, right? So I think this is something where it's often, once you pass that shareholder vote, this is your main issue that you're looking at. So requires I think from a competition standpoint, right? In terms of like antitrust, I don't really see much concern here. The PIF has invested in some other assets. They bought Scopely, which is a biggest game is Monopoly Go, and they also bought Niantic, which has Pokemon Go, but not they're not one of the big kind of they're not a Take-Two or a Nintendo or a Capcom or Tencent, right? So I don't really see that being an issue. What is likely to be an issue and normally would get a lot more scrutiny is kind of the national security angle right here, where you have this U.S. company, a lot of U.S. consumer data, that would be kind of controlled by a foreign country, right, with Saudi Arabia. So you have what's called normally a CFIUS review. And that's something that there's a normal process they kind of evaluate as a security risk. And then depending on, detailed they go, they might try to come up with some like, mitigating, factors to get approval. But I think so. Normally that would be kind of a real unknown here. But this is where I think that kind of the presence of Affinity Partners and Jared Kushner, who just happens to be President Trump's son-in-law, like I personally do not think that's a coincidence that he is part of, or that his fund is part of this controlling shareholder group. I'm personally skeptical that's right. I think this will get a stamp of approval or will not be blocked on kind of that CFIUS grounds. And I believe in terms of the process, like if there is, if they cannot come to an agreement about how to mitigate this thing, like I believe the next step would be, it's referred to the president, who basically has like a couple weeks in the last step to decide if it's allowed or not allowed. So again, like I really don't see this being blocked from kind of that CFIUS angle. So I'm pretty confident that once we get out of this kind of the 45-day go shop, the implied probability of deal closure will kind of jump up, and I would expect the bonds to run a bit further towards that par level.
What is the implied probability looking like now in terms of where the shares are trading relative to the offer price?
So if you look at the equity price today versus, today versus the 210, cash takeout price versus where it was trading before, I think the equity market is implying around an 80% likelihood this deal is closed. However, there has been I think there is some talk about, is the price high enough? So like, although it's like in line with kind of other deals, there's this thing that should they be paying more money? So if you think that like there's a possibility of an increased deal, then the implied probability is actually lower. It could be 60%, something like this. A big thing to watch in the near term that I think could affect if there's a need to raise that price is next week, or I guess, on the October 10th. So maybe the time this podcast is published, I don't know. EA will have this new Battlefield launch, right? So if that game blows up, there's so far in like the beta, it's done really well. And if that is like this huge success, then the shareholders might have more reason to be like, oh, this consortium is trying to come in, kind of buy us on the cheap before this Battlefield launch, before the next World Cup, which should support FC Sports. So we also have that, but I think that's kind of something that we'll kind of know, in the next few days. And I would also personally think that if you do get that shareholder pushback, I think this transaction is so strategic to the PIF that they will just, be willing to kind of kick in more capital if needed.
That's really interesting on the timing of the Battlefield launch, and if that does kind of come out of the gates pretty hot, if that does eventually result in a higher share price, it seems like it ultimately just get boosted in terms of the offer. And I think it's important, your point, how this really is a strategic purchase, not necessarily just a financial one for PIF and some of the other acquisitions that they've made on the video game side. So Kerry, I want to get your perspective on the potential for other large-scale LBO activity picking up. Over here at CreditSights, James Goldstein, our senior retail analyst, highlighted chatter of a target LBO, and AES is also making headlines lately about a potential LBO. So what conditions are you seeing in the market that could drive additional large deal announcements like this one?
Sure. I mean, the other one we've seen, batted around in the press is Hologic as well. I don't think it's quite the magnitude of EA, but it would be pretty big. So, I mean, I think, now that people have been waiting for a revival in M&A LBO activity here for a couple of years, but I think with some of the volatility in Q2 fading and, rates slowly coming down, I don't know if you want to weigh in, Zach, with your expectations on that, but with rates slowly coming down, it makes sort of the LBO boom, it makes these transactions work a little easier. And I think also the elevated interest rates, there's only so much leverage you can put on, certain companies. And I also think that does help explain some of the large equity checks too. But I think the combination of these things, and we feel like we have more visibility, could definitely bring, some more deals to the foray. There's also been from this is like maybe less the jumbo perspective, but there have been a lot of sponsors that have been looking to sell for, quite a bit of time. And they've been waiting for market conditions to be right. So, even if market conditions aren't perfect, if they're good enough, I think you might see a bunch of guys pull the trigger. One indication of this is we've seen just a rash of issuers look to put in place portable capital structures, which sort of makes you think, gee, there must be a whole bunch of people who are kind of gearing up to sell. So I think assuming, there's no major bumps in the road and interest rates, slowly and surely decline, I think we should see a pickup in activity. Which LBO, which are the best candidates for the jumbo LBOs? I'll leave that to the folks at CreditSights.
That's certainly fair enough. And on the rate side, we are expecting rates to continue coming down as growth slows. Maybe the Fed ends up cutting a little bit more than the market's priced for on the back of some of this labor market weakness. It does seem to me there's a lot of optimism in the market in terms of rates can come down, but not because the economy's falling apart. And then we have lower rates, which is kind of a better backdrop for deal making, for equities. And we've seen really strong performance across asset classes this year, even though there are, I'd say, concerning signs at the very least on the labor market side. And I think that could more quickly broaden out into the whole economy as our consumer team sees a little bit more underlying weakness in the consumer than some of the high level macro data have suggested. So to you, Kerry, if you're thinking about what could really derail the market for additional LBOs, is it rates moving higher? Is it the economy slowing a lot more than the market is currently considering? How do you think about maybe the biggest risk to the deal making environment right now?
Gosh, I guess I feel like we've been waiting for this for a while. And, everybody at the end of last year was talking about how, 2025 was going to be a revival in M&A activity. And loans were going to hit this sweet spot because rates would remain somewhat elevated, but we'd have more M&A. And then Liberation Day happened. And then that derailed it. And now we're sort of coming back. I don't know. If there's something, I feel like everything's related. Rates aren't going to go up on their own. And I guess maybe this is sort of a wishy-washy answer, but I almost feel like some sort of maybe shock, that we're not seeing could definitely derail it. But if people do start seeing real warning signs around, the health of the economy, that could slow this as well. I don't know. You have any thoughts on this?
To me, right now, I'd be curious to hear if Hunter has any input on kind of how he's thinking about the rest of his sectors in this context. But it seems like there's just a lot of comfort with AI and that becoming that's a huge part of the US economy. I saw a figure today where it estimates 45% of US economic growth is being driven by AI related spending, which is truly a wild thing to consider. And so I think maybe if something pokes a more sustained hole in expectations for return on all of these investments being made in AI, kind of like what we saw with DeepSeek back in, I think that was February of this year. It feels like it was about 5 years ago at this point with everything that's happened since then. But I feel like for that kind of needs to show some signs of, I guess, concern or maybe more questions on the return on all these huge investments being made. Hunter, I want to end with you. I think we've gone through kind of the high level expectations of this deal, timing, what we're seeing in the leveraged loan market, and expectations for future M&A. Is there anything else interesting in your sector that you think kind of led to this, or anything else that you're keeping an eye on from a more thematic perspective?
Yeah. So in terms of what led to this, like I do think it's so normally whenever you see a company, investors willing to pay such a premium, right? It usually says it implies either this industry is really cheap, it's been beaten down, and people are kind of coming in to to try to take advantage of that. But that's not the case. Like EA is not that far off its all-time high. And I would say, in general, like the outlook for growth for the video game industry, I think it's much lower than a lot of people. Like I know I only started looking at the industry somewhat recently, and I just kind of assumed you have demographics. Young people love video games. Like the people that used to play video games are aging, and just more and more people, more time spent with them. Then you would look at the growth of these companies. So EA is actually does pretty well within the industry. They benefit from having these kind of recurring sports titles, right? That are very popular, but it's not growing that much. Like this is the whole concern of the industry. So like I think there was this initial thing, how positive is this for everyone? Does this imply a lot of bullishness? But the more I dig into it, I do think it is just a function of that unique factor where Saudi Arabia has this plan. They want to diversify their national economy from, away from kind of natural resources. I think in 2022 or 2023, they actually laid out like a $30 billion investment plan to grow the video game industry between a mix of like acquisitions of foreign companies, stakes in foreign companies, investing in studios and creating jobs in Saudi Arabia. So I think it's kind of unique where I would not want to read too much into the broader industry. But one thing back to that AI angle, like that I really would like to hear about is kind of like, what is driving, say, Silver Lake here to participate, right? Like what do they see? And when you talk about cost cutting, as I said, I don't see a lot of synergies. I don't expect them to combine EA with Scopely, with Monopoly Go, or with Niantic. So then it's like, what do they see? How do they want to, what do they envisage that they can do differently to kind of make EA better? And I think a big thing there could be AI, right? If they're like, by investing in AI, this will allow us to either, make these offerings better, create the games faster, make them cheaper. So that's something that if I saw that and I see how much they lean into that, that could have implications both to other video game peers as well as I think kind of the broader media industry, where we're seeing already with like Sora 2, right? Like last week, we're seeing the amount of or just the type of content that can be produced, the quality of content that does raise questions about what does this mean for, so back to kind of your question, sorry to be rambling, but I'll try to tie it up here. The other biggest thing happening in my space, right, is what's happening with Paramount, Skydance, and Warner Brothers Discovery, right? So Warner Brothers Discovery, huge capital structure, drop to high yield, planning to separate the business into a studio streaming business and a linear business. And then we had these press reports that Paramount Skydance, David Ellison, wants to buy the whole company. Right. And then probably a lot of that would be like a lot of a big cash check for that deal as well, in terms of what has been rumored. So to me, you're basically, that transaction would be kind of doubling down on this kind of studio business, right? You'd be combining this Paramount Studios, Skydance was a studio business, HBO Studio, and the big legacy Warner Brothers business. You'd be kind of doubling down on that, borrowing more money against that at this time where I think the whole media video industry has been under pressure. But right now, I think this kind of content production business that that Warner Brothers is kind of the industry leader in is I think uncertainty is kind of at an all-time high, right? Just as we're seeing these like Sora 2, and like that's happened so quickly. So to me, it's just kind of how will that impact things, and like if that deal does happen, like I think there's a lot more uncertainty even beyond the whole linear aspect about what's happening with the transition from, traditional linear TV to streaming TV, about like what happens to content production, what happens to the value of libraries, if these tools can, make it much easier and quickly or democratizes like video content creation.
Yeah, there's a lot of interesting moving parts.
Changing, but hopefully I hit something that was coherent there.
No, I think that's great. And I feel like the kind of resounding message is this is a strategic deal for PIF, the anchor investor. It'll be interesting to see sort of what Silver Lake's angle is, and I'm sure we'll learn about more of that over time. And the other big takeaway is there's a lot of moving pieces in the media space that'll be interesting to keep an eye on going forward. So with that, I want to thank you, Kerry, and thank you, Hunter, for coming on the podcast. I really enjoyed the discussion and look forward to tracking this deal as it kind of makes its way through the pipeline.
Thanks a lot, Zach. Thanks for having us on.
Yes, thank you.
All right. And thank you all for tuning in. We will catch you next time on No More, Risk Better. Good luck out there.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security.